Now, as we turn to the international market, we have to look at what are exports doing from the U.S. And here we're going to try to break it down between products and then the crude exports here. So here you can see gasoline had a drop of about 203,000 barrels a day. Again, not much movement one way or the other. This is one that's going to have a little bit of a headwind, especially as we have a lot of European product that's struggling to find a home. So as we said earlier, there was a shift away from the East Coast and going down into West Africa. The question is, as it's going down into West Africa, is it going to start to get absorbed in parts of Latin America? We're seeing more increases of exports from the Middle East, from Asia, which again is going to start to put additional pressure, especially on gasoline, given the fact that our gasoline flows pretty freely into Latin America. Mexico is by pipe as well as boat, so that's one that's going to be relatively fixed. The question is going to be some of the other areas which we're reaching by boat. Distillate is going to be one that's going to face additional headwinds, as we talked about. We saw a little bit of an increase just because there was some timing in terms of when the boats were released. But as we go through next week and the week after, those are ones that are going to see additional pressure as Indian and just inherent Asian cargoes start to show up within Europe as we see additional flows increase. And as we go through our OPEC part of the economy show and looking at what's happening with OPEC, we're seeing a huge increase in terms of just floating product. So we've had about a 30% increase when we're looking at it month over month. Holistically, it's not across all products. Gasoline came down a little bit, but the problem is diesel and distillate in general has had the biggest increase in floating storage, which again is going to put some of that distillate export into an overhang. As we go through and we look at oil exports, this is again going to be a timing delay. We were expecting a little bit of a drop to about 2.7 to 2.8. This is 2.6. Again, it's going to be an ebb and flow. So we expect an increase, especially as we have additional Chinese exports. The problem that we're seeing right now is even though we have these Chinese exports, the spreads or the arbitrage into Europe is really under pressure, especially as we have additional flows from West Africa, Nigeria, and the Middle East, taking some of that market share. And we do have an increase of Urals or out of Russia into Europe, which again is going to put some of that overhang. So even though China will be supportive in terms of flow, it'll still be relatively capped because Europe is going to be that overhang, which is why we think that we're going to maintain something below 3 million, but something much closer to a 2.8, 2.7, 2.8 million average on a 4-week basis, which is going to be something to watch, because if that doesn't materialize and we still continue to see this overhang in exports, that'll be put additional pressure on builds, specifically in PADD 3 in the Gulf of Mexico. So as we look at exports, again, not much to say in terms of where we are against the 5-year average. We think we're going to start to trend a little bit below that 5-year average, but typically as we see the end of driving season, a lot of the additional gasoline gets shifted into the export market, which you can see from that essentially that 5-year average, that white dotted line trending up and to the right. The problem is that's going to come under pressure. So the question is going to be, how much do we underperform the 5-year average, which is going to put additional weight on what the overall gasoline storage looks like. So the export market is important to watch, especially as if we can't get it into the water and into the market, well, how much can we push up north? And that can be into PADD 1, PADD 2, and just depending on where we are, into PADD 4, which is obviously a little bit harder, but you can do it with rail. So this is why some of the mid-con refiners will remain under a little bit of pressure. Obviously we have a hurricane bump because we've seen pricing respond. So the question is going to be, if these exports, which we think are going to come under pressure, can't go out into the market, it's going to have to be pushed up into the middle of the country. And this is when we start looking at exports. We were expecting something closer to the 5-year average. It's something where we same thing. We're just going to kind of sit around this 5-year average, not much moving too much in terms of where we sit overall. This is one that could come under a little bit of pressure, but just given where we sit, what the demand looks like, we should see this maintain the 5-year average or just below the 5-year average for the next 1 or 2 weeks. When we shift to Japan and Fujairah, Fujairah had a little bit of had a big increase last week. This week, as we start to look at it overall, it's starting to kind of normalize a bit. Japan had a normalization. So the big adjustment here is really the U.S. The U.S. was the one that provided the uplift because Japan had about a net drawdown of 3 million barrels between distillate and crude. Fujairah had a smaller drawdown, but again, that's why we're starting to see kind of this flatlining and normalization, which is going to be a problem as we start to look at what does the winter look like, what does that shoulder season look like, and we see this just kind of flatlining and going to the right. Vital had some positive commentary. Obviously, BP had some interesting commentary, which is something that we're going to talk about a little bit later, just try to look at the different sides of things. But overall, we continue to see headwinds in the market just driven based on not only the oversupply in oil, but in the refined products. And we're coming into a very tough part of the year, which is going to just increase the amount of pressure. As we see some of these pricing here, I mean, the crack spreads and inherent refinery margins remain under pressure, which again is going to, you can only run negative for so long before you're forced to turn around and cut runs additionally, which is something that we're already seeing in Europe, and it's going to have to be rationalized overall, which is going to be a problem. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.